Good morning, traders. It is Wednesday, May 14th. Today I'm going to cover a bunch of interesting things from dividend stocks, some interesting time frames, and how they really are a pretty poor investment in general, and how we have these false misconceptions or false beliefs about the stability and safety of them. I want to show what's going on with the hottest sectors in the market, and they're all coming to life. I want to show you the difference between gold and silver and the dollar during the 2008 market top and what they're doing right now as well. And also show you the big picture of where the S&P 500 could potentially go, which is a pretty bearish outlook. And I'm showing you a different chart there. But first, I'm going to just jump into the really short-term price action of the S&P 500 and just kind of cover what we touched on yesterday in pre-market. We talked about how the stock market had these price spikes, which we see on the SPY. And these are something I've traded for years. And there's certain rules I touched on yesterday. If you didn't watch yesterday's video, make sure you watch it, because these price spikes will give you false signals, and usually the false signals are the biggest ones and the most dangerous ones. And then I also show some interesting content at the end of yesterday's video as well. But let's just zoom into yesterday's price action, ignoring these giant price spikes to the downside, which are false signals and kind of telling you the market's going to do the opposite. We saw the market yesterday generate this smaller price spike to the upside as we work towards the opening bell at 9:30, and I have these levels at 33%, 50%, and 100% measured moves. And typically, when we have a smaller spike in the direction of this trend that we're going here, usually the market wants to run up and hit 1, 2, or 3, all three of those targets. So we end up hitting that right after the open. The opening bell came and screamed and hit those levels. And then really for the rest of the session, it kind of just traded sideways. You can see this morning now we have a small little price spike to the downside, showing that the market might pull back and consolidate a little bit today. When we look at the 30-minute chart, using our panic selling indicator during uptrends as an oversold level, where the market is usually going to get bought up, and these overbought levels, these FOMO indicators to the upside, is telling us when we're in an uptrend, not to sell short, but just to realize the market is going to have some type of pullback, a little one, or pause. Sometimes it doesn't. Sometimes it will just keep muscling its way higher, which is why we don't bet against a rising tide. We just know we're mentally prepared that we could see a little bit of a pause or weakness. In an uptrend, it's the panic selling that becomes a standout low in opportunity, not these FOMO indicators, which again I teach and show in the book on how to set this up on your charts if you wanted to flip and flop between understanding the emotional waves, the short-term emotional waves of investors. Now, overall, let's take a look at let's take a quick look over at the NASDAQ. So overall, the market, we had a sell signal in the market way back over here, understanding and watching everything start to break down. The market sold off this huge wave down. This is where I was warning. Everybody was talking about they wanted to buy, pick a bottom. They bought the 2x leveraged ETFs. Right here, we can see everybody piled in. This is the traders plowed $6.6 billion into leveraged ETFs. That was just in one week. But in February and March is when people piled in. And if you take a look, this is February, the pullback, in March, and this is when I kept saying, bottom pickers, be aware. If everybody's trying to pick a bottom, the bottom is not in. You're gonna pick a big one, and it bled out. Pardon the pun. Anyway, we've seen that happen. Now the market's reversed. We've been talking about a bounce in the S&P 500 to about 58, 5,900 as a dead cat bounce. We do have that. It has been a very strong rally. Depending on how you zoom in and out of this chart, it looks like a V-shaped bottom, but more or less it's finally turned up, stabilized. It's generated a bullish trigger because money's flowing back in. And of course, we've hit our first target on the QQQ and the SPY. We did that with both trades here at this point. And so now we're just letting it mature to see what's going to happen. If the market does go higher, well, we're long the markets. It doesn't really matter. If it does stall and roll over, then our strategy will eventually move us out and lock in those gains. And we don't have to worry too much. That's the whole nice thing about managing risk and following price action. The one thing that's really important here, let's just go back to the S&P 500. And this is what we've talked about for a while here. this resistance level of the market. Sorry, that's the Dow. Let me just go back to the S&P 500. This was a very critical level here for the markets. We talked about this a couple weeks ago, that the market is going to gun and aim for this level. If it can break this pivot high, it's going to create a huge wave of volume. People are going to get really bullish, which they are. Everybody sending in emails is like, hey, you said it was a dead cat bounce. This is not a dead cat bounce. It's a V-shaped recovery. Markets are going higher to all-time highs. People are getting really, really bullish. And while they may be right, in the general scheme of things, our long-term trend is in a bearish phase, and this is a bounce within a bear market. So until it proves that we're in a new bull market, this still is a dead cat bounce to me. And eventually, if the market does push higher, the market will kick into a bull market, and this will become a standout low at that point, and there'll be an entry point. But right now, the sentiment is doing exactly what we want. People are getting very bullish. They're piling into some of the fastest moving sectors. Check this out. This I shared in the members area last night. These are our top ranked sectors, showing that they had triggers, buy triggers, like 13 days ago up 8%, 3%, 3 days ago up 12%. These things are really starting to pop, how much they've really taken off. Look at them, ARK-K, ARK-W, TAN, blockchain, semiconductors. These are like the golden, or so the oil and natural gas miners are fast moving, marijuana stocks, Bitcoin, clean energy again, more technology growth, technology, uranium. This is what the masses generally pile into. The very aggressive traders, when they all start to pile into this, and we saw this at the last market high, usually we're getting very close to the markets rolling over. This is just one day, they're moving 5% and all of that. And just like during the S&P 500 daily chart, we had this huge move down, and I overlaid the Google search term right when everybody tried to pick a bottom here. Then the market collapsed, and we had the first real kind of bear market type of selling and drop. Haven't seen that in a long time. We had a big spike in everyone searching inverse ETFs. On the morning that I said this is where everybody's going to bail on their long positions, they're going to panic out, they're going to then bet on a falling market with an inverse ETF, and the market is going to scream higher. The market is now like way up here. And so now, knowing that people are this emotional and they just really go from total fear of missing out to fear of losing any more, we're waiting now for the sentiment of something else here to shift, for everyone to get bullish. And they are, as I just showed you with those sectors. And that will be, when the market starts to roll over after that, it's going to be lights out probably for a huge correction. So talking about a huge correction, take a look at these two charts. Both are the weekly S&P 500 chart. This one here is the tech bubble where it collapsed. And then we had the 2008 financial crisis, which even broke below the S&P 500, the 2002 low. And that was a 57% pullback. Well, if we take a look where we are now, we've broken to the downside. We're having this bounce back up within a bearish phase. You can see where 57% downside is. And based on a bunch of different analysis, this is pretty much a very significant level on the chart that actually Fibonacci brings us to as well. Fibonacci retracement going from the 2008 lows brings a level right through here, and it happens to be the same as what we saw previously. So you can see, if you thought this little pullback recently, a 20% pullback, was scary, try something that's going to wipe out a decade, a lot of growth in earnings, and the fear and the stress that comes with that, and the bankruptcies and all of that. It could get very ugly. And I'm not saying this is going to happen, and I know I'm like a perma bear because I'm always trying to protect everyone. You're better to be expecting and have a strategy for things to go bad in the markets, because when they do go bad, it goes fast. Again, things take the elevator down. You need to be proactive, not reactive. And this is always what happens, right? Nobody wants help up here through here. Everybody wants help down here. And then the market rebounds. They don't want help again. And then they do their own thing and the market crashes. It's just a wave of emotional traders. And I'm all about being proactive, having a plan. When you have a plan, you're not a fearful trader anymore. I know most of our members are drooling like I am for a huge market crash. Not only can we make money on the way down with inverse ETFs, but we're going to be able to reinvest and be richer than we've ever been in buying all the stocks and commodities that we want when they're like way undervalued, or at least crazy fair valued. So that's kind of the view that we're going for. So just to take things a notch further, this is the 2008 market top, 2007, 2008, just the top phase with gold line chart. And then this is where we are right now. And you can see recently we had a 21% pullback, a crackdown after a little bit of after a little bit of a double top here. We had this and then a huge crack to the downside. So we're down 21%. Well, if you take a look at what happened in 2007, we had a double top and then had a huge crack down, 20% as well. At that time, gold shot higher as the defensive play. Everybody was getting nervous. Uncertainty was crazy. And we've got the same thing here. So we're in a very similar situation. And of course, everybody automatically says, well, this is not like 2008. Of course it's not. Every bear market has a whole new scenario. Everything always feels totally different, and it is totally different, but price always does the same thing. It goes up when they're bullish, it goes down when they're scared, and it doesn't really matter what the news is. We just have to follow the money, follow the price, and forget about the noise of everything else. There's a million people out there that'll give you all the insight you want on news and economic data. But the reality is price goes up, down, or sideways, and you just need to know how to follow it. Who cares if it's a different scenario? When people are scared, it doesn't matter if they're scared of a tech bubble bursting. It doesn't matter if they're worried about the housing market bursting. When they're scared and they're selling everything, everything goes down. And that's the reality of it. If you just look at the markets from a high level, it's up, down, or sideways. How do you manage your positions? How do you manage your risk? That's how I see it. So on that note, some of you wanted to see how silver moves with these. So let's take a look at silver here on 2008. You can see the white line here is silver. It pretty much mirrors what gold does. Silver is more volatile. So if gold rallies 3%, silver might rally 12%. Like it just has, they still generally move in the same direction. They're the same play. If we go to where we are right now and throw silver on, again, both of them moving up. Silver is just a lot more volatile. It always is, it's the same. If I was to go back to, if I was to fast forward here to 2000 to the bottom here, let's go to the bottom of the stock market and let's just zoom in here. You can see gold and yellow, gold and white lines are gold and silver. They pretty much move together up and to the right. So it's the same pretty much with gold miners. They're all the same play. So everybody who says, oh, I'm diversified, I have a whole bunch of miners stocks, I got large caps, I got small caps, I got gold, I got silver. They're all the same thing. Just, gold is the slowest mover and silver and miners and stuff are the faster mover. And that's just the reality of how that kind of works. So let's take this a notch further and just take a look at what the US dollar has done. Back in 2007, 2008 market top, the dollar crashed and fell out of bed, which is why gold became the favorite play. As the dollar falls, we generally see gold move up. So dollar down, gold up. Nobody wanted the dollar. Everybody was hating the dollar. Everybody wanted gold. Well, if we take a look at where we are now, it is the same. Pretty much. We haven't seen gold, the dollar fall this way, but percentage-wise, it has had a massive move. It has completely collapsed. In the grand scheme of things, it has gone, on its way lower. Well, gold has been going higher, and nobody wants the dollar right now. Everybody wants gold. Everybody who's not in gold has serious FOMO of missing out. And again, as we look forward in time, when we go through these markets, the stock market collapses and falls dramatically. It will pull gold down. The US dollar tends to rally. So selling pressure pulls most commodities and assets down. And usually when we go into a financial crisis, the dollar shines and a rising dollar also pulls gold down. And I believe that's what we're going to eventually see. We're going to see gold in the stock market sell off, and we're going to see the dollar rally back up and potentially gain quite a bit of strength, which is not what most people are thinking or feeling, which is, it's a contrarian play. It's just how the markets tend to move. And usually the market does what most of us aren't expecting or don't want. It's just the way it is. So on another note, looking at the hot list here, we have with our band trading strategy, we have been in a few plays. We have locked in gains in IBIT, which is the Bitcoin play, which I'm not sure where Bitcoin is this morning. Let's take a quick peek. Bitcoin is down 0.6%, 0.7%, still flagging sideways. Bitcoin is still has a bullish chart. Rally, pause, rally, pause, rally, pause. this pause is right through resistance. If it gets traction, this baby is going to pop. We are long Bitcoin with the band strategy. We've got all the moving averages layered and fanning up, which is a good sign. And the monthly chart is pointing to $135 per Bitcoin if this pops and breaks. But that means the stock market also has to keep pushing higher, I think. They pretty much still move together. So if it does stall out the stock market over the next week or so, Bitcoin might just come down and have put in a 1, 2, 3 triple top and then have a much higher volatility topping phase, which if we were to zoom out on this chart, go way back here. That would be a massive topping phase, and eventually it could break down, and I think it'll collapse with the overall stock market. But again, that goes against everyone, most people's opinion. If you're a Bitcoin lover, you're going to hate me right there. Anyway, let's take a look back at the hot list. So we are long Bitcoin. We have locked in gains. We have our stop in the profit. So we're no matter what, we got a winning trade there. URA we've been in. We've also locked in gains. It keeps pushing higher. It's running up this 5-day moving average, which is the signs of a good high momentum move. I was talking with Steve Barton on a podcast yesterday. They're long uranium stocks as well. And it's right through this resistance area. We've hit our target. Anything now is kind of icing on the cake. When the stock market rolls over, it's going to pull over Bitcoin. It's going to pull over uranium. It's going to pull everything over with it to the downside. So right now we're just letting it run and mature, and we've got targets further up. And if the trend changes, then we close our position from there. The other trade that we were in, which was GLD, it was at the top of the list. Now it's down near the bottom. It's losing its momentum. And this morning, you can see here just in pre-market on this 10-minute chart, it's bombs away. It is trading down at 293. So it is breaking down and selling off. We got into gold right here. We sold right here. And now it looks like it's going to unwind in a bigger way. And if you saw me talk about gold a few days ago, I talked about how these really unique scenarios, if we go to the monthly chart, and I'll just fly through this really quick so we can keep this video not too long, but more or less every time we hit Fibonacci targets, so we could go way back here to 2001, where the start of a bull market super cycle was to the low, and we carry that forward. This is where we are expecting gold long-term, like forever ago, 2027, 2800 range. We also, after this first kind of super cycle and this pullback, we had this new breakout. The super cycle, the next one started in 2019 when it broke out of this base. And then we come down to this low here. This is also another one. Both of these patterns, the 20-year and the more recent one, come to this area. And what's really important, I think, here to stand out, and why I am fairly, I'm not betting against gold, but I am feeling like it's putting in a major top. Every time we hit one of these measured moves, we had another Fibonacci measured move. We had another Fibonacci measured move here. We had another one back over here, another one back over here. And after we hit these 100% measured moves, we see gold pop and run higher. And what's really interesting, all of these, including this one, it may look bigger, but it's still the same. They were all 22 to 24% before the market paused for a year or sold off in a big way. And so that's where we are. We got these upper tweezers candles, which are these long wicks, meaning gold ran up, got slammed down. It ran up, it's getting slammed back down. Those are usually reversal bars. Sometimes they can be a pause, like here. We've had some here. It ran up, got slammed down, and it held its ground. It didn't break down, and then boom, it was able to push through and run higher. But now that we've hit this 100% measured move on multiple time frames, 20-year, 5-year type of thing, and we've hit this 24% push and blow off phase where gold runs up and becomes that defensive move, is definitely a red flag. And I'm concerned where gold is going to go. I'm not really concerned. I'm excited. Gold pulled back in the last financial crisis 34%. And if we were to look here, 34% is right down around this level here. And believe it or not, if we use Fibonacci retracement and we go from this start of this super cycle and we bring it up to the high here, this purple line, this 50%, I know it's getting pretty ugly, this chart, but this is the sweet spot for a correction in gold. the 38% retracement to 50%, which brings us down to 34% retracement, just like in 2008. Now I keep showing 2008. Everything aligns to move similar to 2008. Again, it's a totally different scenario this time. It always is, but price is price. It doesn't really, it has a memory of previous price action, but it doesn't know what's going on in the news. We just have to follow price, and it's just, the market doesn't generally repeat, but it rhymes. So we can expect something in this range. Maybe gold pulls back, only to here. Maybe it pulls back down to the 61% retracement. Who knows? We just need to know that big turning points are coming, and we need to adjust and manage our portfolio going from there. Okay, let's take a quick look at gold. This video is getting really long. Sorry, guys. But let's take a look at gold, and let's look at the daily chart because it is selling off in pre-market today. Let me clear the chart. We are seeing gold break down. It's starting to pick up speed, and it's going to flush things out. So in the grand scheme of things, we are out of gold on our band strategy, and really we're just going to let the market do its thing. You could argue the monthly chart with those tweezers look very toppy. We can also see these two moves, which are the two tweezers on those monthly charts, April and May. And now we're potentially breaking down, and gold could have a precipitous, decline going forward. So be aware if you are a gold bug holding gold and drooling and saying, hey, this is going to the moon. I know there's all kinds of guys saying, gold is just going to shoot straight higher. I would go with statistics. I'd go with what generally has happened, and I'd follow price. I wouldn't trust people saying, it's going to 7,000, 12,000. It's going straight up. The scenario right now is amazing for gold. It's always good for gold. The world's always falling apart. The U.S. is corrupt. Every country is corrupt, and currencies are fiat currencies are falling apart. But price, you don't get sucked into the news and the hype and the huge potential gains. It will get you on the wrong side. All right. Last but not least, let's take a look at. Let's just take a look at the S&P 500. And just kind of what's happened recently in terms of dividend stocks. So we've seen the S&P 500 fall 21%. As of where it is right now, it's down about 4%, the SPY. If we were to take a look, I think actually, let's just go to the dividend stocks. I think that dividends peaked out a little bit earlier. So if we were to take a look at dividend stocks, this is November 27th. So dividend stocks from their high fell 20%. Dividend stocks are still down roughly 10%. So they're down more than the S&P 500. And if we go back to the S&P 500, let's compare it to the same level here, the same window, which was the 27th for somewhere over here. And so more or less, you can see the difference. The S&P 500 is really only down 2.7% from the same time. It fell 20%. Yet dividend stocks are down. They fell the same amount. You took the same risk, and you're down like 3 times more than. And dividend stocks are not very safe. Yesterday, the stock market screamed higher. Dividend stocks sold off. Everybody's moving into the really speculative trades, as I showed you with the sectors, the ARK ETFs and uranium stocks and all that stuff right now, and they're dumping dividends, boring old dividends. And this is not a very strong pattern. This is a sell-off, pause, sell-off, dead cat bounce, crash after this. So very, very ugly kind of scenario. What's also interesting is the longer term view. Let's just compare the dividend stocks up at the top. So those of you who are, have bought into the dividend theory of buying dividend stocks. If we go to the COVID high just before COVID went down, you can see dividend stocks, you're up about 6%. Also, during that crash, you suffered 46% drawdown. Dividend investors freaked out. They got the worst end of the stick at that point. When the SP 500, if you just bought the index, you were down 10% less. And if you stuck with this, you're up 73% versus 63%. Just because you get paid an extra 3% more a year of dividends does not mean you should suffer half of your, much more volatility with very little upside. And this is the biggest problem with financial advisors, and everybody's saying, oh, do the drip, dividend reinvestment, just get into these big solid companies. They're super strong. Guys, the reason dividend stocks are so dangerous is because the majority of money in the stock market are people 50 plus. And they all have advisors and they all do the same thing. They all buy into the same BS, which is buy and hold, buy dividend stocks, the big solid companies. They're not going anywhere. They're paying dividends, making profits. Well, when all those people panic at the same time, they're selling a very select specific stocks all at the same time. And that's why they get hit even more versus spreading it out over 500 stocks. This is, going to be a much smaller basket of all those investors, retirees dumping, calling their advisors. So anyway, I showed this also with hedged ETFs using covered call ETFs, and they have the same thing. More downside risk, no upside. Really kind of just they're just tools. People make stuff to sell them. Whereas we just want to navigate these markets and avoid chaos, profit from chaos, and avoid noise and chop, and make sure we've got high probability trade setups. Anyways, long video, but hopefully you guys got a lot out of this. I kind of wanted to go into some detail and show the whole spectrum of what's going on. All right, take care. Bye-bye.